Hello friends, this is Ruchira Vaidya and you are watching my YouTube audit channel that is for CFI students and auditing. I hope you all are doing well. This has been a long time. So in our last lecture we have studied the SA 300. In this lecture we will be doing SA 315, that is identifying and assessing the risk of material misstatement through understanding the entity and its environment. Now friends, let's begin with the definitions. Assertions. Now what does assertion mean? It means representations made by the management, explicit or otherwise, included in the financial statements. Second is business risk. A business risk is a risk resulting from significant conditions, events, circumstances, actions that could adversely affect the entity's ability to achieve its objectives. Next is the risk assessment procedures. The risk assessment procedures are the audit procedures performed to obtain the understanding of the entity and its environment, including entity's internal control, to identify and assess the risk of material misstatement, whether due to fraud or error, at the financial statement level and assertion levels. Now, the next definition is significant risk. Significant risk is a risk, or it's an identified and assessed risk of material misstatement that in the auditor's judgment requires special audit consideration. Now friends, next question is sources of misstatements. In this points I have highlighted with a different pen the key points so that you will be finding it easy to understand and to interpret the same. Okay, so misstatement can result from fraud or error and consist of the following. Number one, the omission of an financial statement element, account or item. Number two, an inaccuracy in gathering or processing the data from which the financial statements are prepared. Next is a financial statement disclosure that is not presented in accordance with the generally accepted accounting principles. Next point is the omission of information required to be disclosed in conformity with generally accepted accounting principles. Next point is an incorrect accounting estimate arising, for example, from the oversight or misinterpretation of facts. Next point is the differences between the management and auditor's judgment regarding the accounting estimates or selection and application of accounting policies which the auditor considers inappropriate. Okay friends, so our next question is risk assessment procedures and related activities. Now this include the 4 points: inquiries of management and others within the entity, analytical procedures, observation and inspection, and related activities. Now let's see each of them in brief. Now friends, inquiries of management and others within the entity. Now these include the inquiries towards those charged with governance, inquiries towards internal audit personnel, inquiries of employees who are involved in initiating, processing or recording complex or unusual transactions, inquiries towards marketing or sales personnel, inquiries towards in-house legal counsel, and so on. Next point is analytical procedures. Analytical procedures may help to identify the existence of unusual transactions or events and amount, ratios, and trends that might indicate matters that have audit implications. Next point is observation and inspection. Now, observation and inspection may support inquiries of management and others. It includes the entity's operations, documents such as business plans and strategies, reports prepared by the management, and those charged with governance such as minutes of board of directors meeting, the entity's premises and plant facilities. Next point is related activities. The auditor shall consider whether information obtained from the auditor's client acceptance or continuance process is relevant to identifying risk of material misstatement, where the engagement partner has performed other engagements for the entity, when the auditor intends to use information obtained from the auditor's previous experience with the entity and from audit procedures performed in previous audits. The auditor shall determine whether changes have been occurred since the previous audit. The engagement partner and other key engagement team members shall discuss the suspectability of the entity's financial statements to identify the risk of material misstatement and the application of applicable financial reporting framework. Now, friends, next question is the knowledge of the client's business. It includes industry, regulatory, and other external factors. Nature of the entity, including the entity's selection and application of accounting policies, objectives and strategies, and related business risk, measurement and review of entity's financial performance, internal controls. Friends, let's begin with the first point: industry, regulatory, and other external factors. The industry factors include industry conditions such as the competitive environment, supplier and customer relationships, technological developments. Examples include the market and competition, including the demand, capacity, and the other competition, cyclical or seasonal activity, product technology relating to the entity's products, energy supply, and cost. The regulatory environment includes accounting principles and industry specific practices, regulatory framework for a regulated industry, legislation and regulation that may significantly affect the entity's operation, taxation, corporate, and other, and so on. And other external factors are those factors which affect the entity that the auditor considers. It include the general economic conditions, interest rates, and availability of financing, inflation, currency revaluation, etc. Next point is the nature of the entity, including the entity's selection and application of accounting policies. It includes whether the entity has a complex structure, for example, with subsidiaries or other components in multiple locations. The ownership and relations between the owners and other people or entities, related parties. Next point is objectives and strategies. Now, strategies are the approaches by which management intends to achieve its objectives. The entity's objectives and strategies may change over time to time. Business risk is broader than the risk of material misstatement of the financial statements. Business risk may arise from change or complexity. Next point is measurement and review of the entity's financial performance. In this case, the auditor should consider key performance indicators, including financial and non-financial, key ratios, trends, and operating statistics, period-on-period financial performance analysis, budgets, forecast, variance analysis, segment information, and so on. Next point is, friends, internal controls. An auditor should obtain an understanding of the internal control in identifying the potential misstatements and factors that affect the risk of material misstatement, and which will help him in designing the nature, timing, and extent of further audit procedures. Now, friends, the next are components of internal control. Let's begin one by one. First is the control environment. Control environment includes understanding the entity's processes and communication and enforcement of integrity and ethical values, commitment to competence, participation of those charged with governance, organization structure. Second point is risk assessment process. An entity's risk assessment process for financial reporting purposes is identification, analysis, and management of risk relevance to the preparation of the financial statements. Next point is information system and communication. The information system relevance to financial reporting objective includes the accounting system, whether automated or manual, and records established to initiate record process and report the entity's transactions. Next point is the control activities. This includes authorization, segregation of duties, safeguarding, asset accountability. Last point is monitoring. Monitoring of controls is a process to assess the quality of internal control performance over time. It involves assessing the design and operation of controls on a timely basis and taking necessary corrective actions. Friends, next point is identifying and assessing the risk of material misstatement at the financial statement level and the assertion level. At the financial statement level, the auditor should consider that the risks of this nature are not necessarily risk identifiable with specific assertions at the class of transactions, account balance, or disclosure level. Assertion level, a risk of material misstatement at the assertion level for classes of transactions, account balance, and disclosures need to be considered. Account balances, balance sheet include existence, rights and obligations, completeness, valuation, and allocation. Classes of transactions include statement of profit and loss, occurrence, completeness, accuracy, and so on. Now friends, we come to the last question, that is risk that requires special audit consideration. The auditor should consider whether risk is due to fraud or error, whether risk is relating to significant economic, accounting, or other developments like changes in regulatory environment, the complexity of unusual transactions, whether risk involves significant transactions with the related parties, whether risk involves significant unusual transactions. So friends, with this we have completed the essay 315, that is identifying and assessing the risk of material misstatement to understanding the entity and its environment. Friends, please watch this video, and if you have liked this video, please give a like, and if you have not yet subscribed my channel, please subscribe it. See you soon. Take care. Bye all.